Hey everyone, so in this video I'm going to be talking about depreciation and taxes, sort of introductory accounting principles that you need to know for upper year finance and accounting courses. So in this one in particular I'm going to be discussing how depreciation works with respect to taxes. So just an idea of why depreciation is necessary in accounting. So basically the idea behind depreciation itself is that when you buy equipment or machinery as a company, let's say you're an industrial company, that machinery gets worn out over time. So if you have it recorded as an asset, let's say you have refinery equipment if you're an oil company and you have it recorded on your books as worth, let's say, $10,000. It might be worth $10,000 when you buy it, but over the period of time it's going to get worn out, it's going to get broken, repair damage, all that stuff. So you have to take that into account and you have to decrease the value on your company's books, on your balance sheet. And depreciation is how we do that. So the method I'm going to be teaching is the most simple and sort of the most commonly used. It's called the declining balance depreciation. I'll go over what that means in a minute. So here's how it basically works. So when you purchase an equipment, let's say, like I mentioned, we'll go with the same example. So you purchase all refinery equipment for $5,000. So right now when you purchase it, you can record it as an asset in your books for $5,000, and that's fine. So initially that $5,000 can be known as the undepreciated capital cost. And that's what it's worth right now at the time of purchase. But every year or every month that goes by or every specific period of time that goes by, you have to reduce the value of that machinery in your books by a specific amount. And that specific amount or that percentage is known as the depreciation rate. So the depreciation rate or the amount that you depreciate is actually calculated as the amount of undepreciated capital you have, so let's say the $5,000, multiplied by the rate. So let's say we have, the CRA actually establishes a bunch of rates for different types of equipment. So you can easily look that up online. It should be in textbooks as well. So let's say the depreciation rate is 10%. That means 10% of that 5,000, you have to reduce the value in the books of that 5,000 by 10%. So that means 10% of 5,000 would be 500. So you're going to take off 500 in the first year. Next year, the thing is only worth 4,500 now. Now you're going to take off another 10% of that moving into the next year. And you keep doing that, like an additional 10% off every single year. And that's basically what the last line over here is. The amount at any specific time, or the value in your books at any specific time, is the amount that it was the year before minus the depreciation you accumulated in the given year. And just a quick point as well, accumulated depreciation is basically if you sum up all the depreciation that has taken place from the day you bought the machine in the first year to specific amount, let's say 5 years later, 6 years later. So if you add up the depreciation of the first, second, third, fourth, fifth, like however much time has passed, all that depreciation put together is known as the accumulated depreciation. And basically the use of this is, let's say, when you're trying to forecast the company's balance sheet or something like that, this is really useful and almost necessary most of the time to forecast it. So I'm quickly going to switch to an Excel sheet over here where I created a quick depreciation schedule to sort of show you what that looks like. So going with the same example, I'm assuming that we have an initial undepreciated capital cost of 5,000. So this is basically what we purchased the machinery for. And the depreciation rate is 15%. I just put 15% for now, but usually you'll be given the rate. So in year zero, at the first, so this is just a matrix that I made up, and this is usually what the depreciation charts look like. So you have year zero, when you purchase it right now, the undepreciated capital cost, which is what it's worth in your books, is on your balance sheet, it's $5,000. Fair and simple. So in the first year, one of the rules that you actually have to keep in mind is that you have to depreciate the asset on your books, but you don't do it by a full 15% in the first year. You'll actually do it by half the depreciation rate in the first year, and then at the full depreciation rate every single year after that. And the reason for that, or sort of the logic behind that, is that machinery is not necessarily purchased at the beginning of the year. It could be purchased in May, June, July, and it wouldn't really make sense to depreciate it fully for the first year. So if you bought it in July, it would only be depreciated from July to December of that year, not from January to June of that year itself. So just to sort of uniform that process, we multiply the first year's depreciation by half, and that's how we get 375. And your ending undepreciated capital cost is simply a subtraction. So you had $5,000 and you depreciated $375 worth of that equipment in year 0. You subtract that out and you're left with $4,625. So for the next year, when you're starting off the next year, January 1st, it's basically the same thing. You can link these two numbers. You're starting off with $4,625. Now the next year, the same thing happens. It's sort of a recursive process. You have $4,625 and the depreciation rate is 15%. So you scratch off 15% off this asset's remaining value. So you're scratching off $694 approximately. And now if you subtract that value, 4,625 minus the 694, this is the value of the asset in your books at the end of year 1 of owning this asset. And that basically carries on forward, and the formula keeps sort of recursively going until such time that the asset reaches at the end of its useful life, or let's say you actually sell it off for a specific amount, and I'll cover that in different videos. So this was basically the idea. So the book value of this asset after 4 years would be $2,414, and that would basically be 5,000 minus, you can see that the sum of this is actually 2,586, and if you do 5,000 minus that, you should get this number as well. So hopefully this helps you understand depreciation schedules and how they work. I'll link this Excel file down in the description below so you can have access to it. And I'll be making more videos on depreciation and taxes and how they all work together, so stay tuned for that.